Markets have maintained their positive start to the year, with global equities rising just over 7% in local currency terms and 18% in euro terms due to the euro weakness, while Eurozone bonds are up almost 7%. Gains continue to be driven by the supportive monetary policies being adopted by global central banks and expectations of an improvement in the growth backdrop following a lacklustre performance in the first quarter, particularly in the US, which has been impacted again by severe weather and a port strike on the West Coast. One of the most notable developments year to date has been the continued weakness in the euro, which has fallen approximately 12% against the US dollar since December. The euro has fallen from its high of just below 140 versus the dollar last May, when the ECB first suggested it would pursue a looser policy stance, to its current level of 107. Despite the euro apparently having overshot to the downside, with fair value against the dollar on a number of valuation measures averaging between 115 and 120, further weakness in the euro is still possible. This is due to the fact that the ECB and US Fed are following divergent monetary policy paths, with the Fed having finished its asset purchase program QE3 last October, and US interest rates expected to rise at some point in 2015. While in contrast, the ECB is loosening monetary policy, having just begun its own asset purchase program, which will continue until at least September 2016, and with the ECB not expected to raise interest rates until at least 2018. These contrasting monetary policy stances, combined with continued expected flows out of euros, given the low or negative yields available on many Eurozone sovereign bonds, can lead to further weakness in the euro, with parity against the dollar possibly being reached late in 2015 or into 2016. While Greece obtained a 4-month extension of the existing bailout programme at the end of February, the failure by Greece to sign up to a definite reform agenda has prevented the release of funds under this programme and has led to funding difficulties for the Greek government, with cash buffers in state-related enterprises currently being used to service ongoing commitments. While Greece made a repayment due to the IMF in April, there are concerns that Greece might not be able to make repayments of over 900 million due to the IMF in May and over €7 billion due to the ECB during the summer. Given the significant negative consequences for the Greek economy if it fails to reach an agreement and gain access to the required funding and is forced to exit the euro, with the likelihood of a significant fall in value of the new drachma on its introduction, a subsequent significant rise in inflation and interest rates, a significant risk of a collapse of the banking sector, and difficulties in sourcing funds from other sources, we believe an 11th hour deal and ultimate compromise is still the most likely outcome, despite the ongoing brinkmanship. In the event of a policy mistake and worst case scenario of a Greek exit from the euro occurring, we do, however, believe the firewalls and protections put in place across the Eurozone since 2012, in particular the recently announced ECB sovereign bond asset purchase programme, would limit contagion to other peripheral markets by putting a cap on any rise in peripheral bond yields, and could in fact result in a stronger Eurozone by providing an incentive for other peripheral countries to ensure they remain in the euro. Eurozone sovereign bond yields have fallen to historic all-time lows, with German 10-year yields currently at 0.07%. This has been driven by the continued low levels of Eurozone inflation, most recently at a negative -0.1% year on year, and the ECB's asset purchase programme, which is significantly larger than expected. With the ECB buying over double the net issuance of sovereign bonds over the course of the programme, with two of the largest holders of bonds, banks and insurance companies, being reluctant sellers of bonds for regulatory reasons, and with the ECB indicating it will buy bonds down to negative yields of -0.2%, short-term pressure on yields is likely to remain to the downside, with German 10-year yields possibly going negative. Through 2016, some upward pressure on yields could be evident as Eurozone economic growth continues to improve and inflation is expected to move back into positive territory through base effects and the impact of the weaker euro. Equity markets, we believe, still provide upside. Despite a softer economic backdrop in Q1, particularly in the US, continued strong labour markets, relatively high consumer confidence levels, improving lending conditions, low oil prices, and recent improvement in auto sales all suggest the global economy is set to rebound through the remainder of 2015, which should be supportive of earnings. Continued accommodative monetary policies from global central banks and extremely attractive valuations relative to other asset classes are also supportive of equities, although in the short term they remain sensitive to developments in Greece. Despite the sharp fall in the euro since last May, further weakness is possible, although the pace of the fall against the dollar is expected to slow. In the short term, Eurozone sovereign bonds are likely to be supported by the ECB's asset purchase programme, although some modest upward pressure on yields is expected through 2016.